Well, this will be the last market outlook that is including 2023 data. When I do this next week, it'll be the first full year of 2024. Have a look at the 10-year. Started the year at 388, finished the year at 388. If you weren't paying attention, you would think, market really did nothing. But the volatility, all the way to 5%. Before coming back down, 112 basis point drop. Incredible. Money market rates all well behaved. Don't pay too much attention to these increases here. You have three things going on. It's end of month, it is end of quarter, and it is end of year. And money tends to shift around a lot at the end of each month, shifts around a lot at the end of each quarter for window dressing, and then it really shifts around a lot if it's the end of the year as well. So those will disappear by the time we get to the end of next week, or the end of this coming week. Those will disappear and they'll be back in line. And long rates all well behaved as well, taking a breather from the incredible rally that they had. I mean, again, the 10-year had a peak of 5% down to 3.88, and that all came in like the last 6 weeks, 5 weeks, 6 weeks of the year. I anticipate that yields will take a break for a while. They're pricing in double the amount of rate cuts that the Fed is pricing in, and I think we're going to need to see some continued data before the market really starts to believe that the Fed, in the next summary of economic projections, I think in early March, will begin to pencil in 4, perhaps, or maybe 5. The market's a little ahead of itself, and I think it'll probably take a breather. So I think I wouldn't look for too much excitement in the yield curve probably until the next Fed meeting, unless we get a jobs report this Friday that is off the charts bullish in terms of the economy. Then you'll probably get some of the rate cuts priced back out of the market and continued volatility in yields. But for now, I don't know that there's much desire to start pricing in 7, 8, 9, 10 rate cuts and have yields push higher. I think now we had a good run. I think we're in a consolidation period for a while. I don't see a sell-off, but I just, continued rally like this can only end badly. Where we are now can end well if we just kind of go sideways for a while. Curve inversion still hanging out around the 40 basis points at 35. Some weeks it drops, some weeks it increases, but pretty much hanging out there. On the 3-month to 10-year, again, pretty much hanging out at 150 basis points until the Fed starts cutting. I don't know that we're going to see a much uninversion here unless the 10-year starts going back up from 388 back up. I don't know that you're going to see too much inversion here. Canada, just still not looking good. I'm still in 2024 on my bet that Canada cuts rates before the Fed cuts rates, only because I think they have to. The balance sheet runoff from the SOMA down $13.5 billion. That still continues, even though we're not doing anything with rates. That is still going on in the background. 7.111 trillion now. I imagine by the end of February we will see a 6 handle on this thing. And while it's not significant in itself, the changing of the 7 to the 6 will be a big discussion somewhere. Balance sheet itself, 7.7 trillion, 7.712, down from 7.724, a drop of 11.3 billion. But balance sheet runoff was 13, at least the SOMA runoff was 13.46. So on net, the Fed balance sheet increased by 2 billion. Money market funds, and again, I don't know that we can read too much into this being end of month, end of quarter, and end of year all at the same time. Increased by 16.35 billion, retail up 13 billion, institutional up 3.35. Government pretty much equal on both, almost 9 billion here, almost 10 billion here. Prime up 3.2, and money coming out of here now 7.02. Next, FOMC, January 31st is now 31 days away. December minutes we get in 3 days. We get on Wednesday. Market is closed on Monday. So we have Tuesday and Wednesday. It's a jobs week. Whenever we have a jobs week, it's a whole bunch of stuff jolts. In 3 days, ADP, the always wrong ADP in 4 days. It's been 20 years now that it's been known as the always wrong ADP, yet it still moves markets. The market still responds to it. I don't know why. And non-farm payrolls in 5 days, both US and Canada in 5 days. This week, no bond sales. No Fed speak. All we really have in terms of economic data is ISM manufacturing. The previous read was 46.7, but being that manufacturing makes up, I think now it's like 18% of the economy, it's not as important to services. Rate cut, 25 basis points, 16.5% probability, up from 14.5, edged up just slightly on low volume. No change, which is where I am. I'm pretty much 100% at this point. I think the January meeting is just too soon to be cutting. 83.5% lower probability, down from 85. And if we go to June, the probability, the Fed's got 3 rate cuts penciled in. So what's the probability of 3 rate cuts or more? 85%, down from 89.8%. Effective federal funds rate 5.33%. Reverse repo, this is common. I already pointed that out for end of months, end of quarters, and this is again end of year, so it's very common to see this happen because it's a lot of positioning for reporting and a lot of positioning for balance sheets and a lot of moving money around at the end of a month, at the end of a quarter, and the end of the year is even bigger. This $246 billion increase, we're back over $1 trillion. That will disappear by the time I do this next week. It wouldn't surprise me if we're well under the 772 and see the reverse repo continue its march downwards. But that is just positioning. There's no information in there. End of month, end of quarter, end of year, all at the same time. The lag, we go back a year. The effective federal funds rate 12 months ago, 4.33, 100 basis points. If we accept the lag, 100 basis points, still yet to be felt in the economy. So I'll make a point later on that when I look at the forecast that my recession watch is about, can the Fed lower rates faster than the lag can hit the market? You know, and if they can, we may avoid that extra 100 basis points. On the other hand, I do believe, given the nature of our global economy, given the technology underlying the majority of things that we do, and technology is deflationary, I do believe the neutral rate is much higher. Because of it, you can have a level of activity that is much higher without inducing inflation. That's why the real rate would be much higher. And in a world of financial sophistication, in developed economies, there are so many products to immunize yourself against interest rates that a lot of the economy is just not as sensitive to interest rates as they used to be. So it's almost as if, you know, did raising the rates really do anything here, or was it just the improvements of supply channels that did something? I think raising rates probably wouldn't have been needed to the extent that they were raised, and it made housing just such a fantastic investment because it restricted supply even more. Real rates all well behaved. This is kind of interesting. As I thought, I got to recheck those numbers. That can't be right. They all moved just 1 basis point, every single one, and inflation expectations creeping down a bit, but well behaved. Nothing to see here, folks. Looking at Fed funds futures, we now have the December contract on the 12-month screen, and we start with January. This is fully 2024, so we can do away with SOFR and just use Fed funds futures, pricing in 145 basis points throughout the year, basically equal to 6 rate cuts, which, if we believe the Fed, may be aggressive. However, if inflation continues to come down, and I think it will, because again, we do live in a deflationary world, and it has been or a full 2-year cycle now from when inflation really started to take off. Businesses adjust, economies adjust, new businesses start, and enter industries where there were supply constraints. Supply channels are redirected to other locations. So, you know, how long of an adjustment do you need, right? So January, there's no change on January in the Fed funds futures, anticipating zero activity by the Fed. By the time we get to the end of June, the first half of the year, we're seeing 66 basis points, roughly 2 to 3 rate cuts, about 2.5 rate cuts in there. And by the time we get to September, there's another 41 basis points and then another 38 into the end of the year for a total of 145. And if we think that, oh, hang on a second, that's going to be a little too aggressive, thinking that we're going to get somewhere between, by the end of Q2, 2 to 3 rate cuts by the end of June. If you think that that's a little aggressive, then the 95.335 is too high, because this is an index, right? 100 minus R. So if there aren't going to be that many cuts, R would be higher, the index would be lower. You would short the June Fed funds futures. I think that that shorting them is kind of a dangerous thing to do, because if something breaks somewhere globally, and we do live in a world that's a little bit more precarious now, you have Russia doing what it's doing, you have the Middle East situation, of which there's always been unrest in the Middle East, but it's really come to the forefront now. And if you have, you know, Iran, China starting to pick sides in this, well, you know, things could get a lot worse. You have Red Sea problems going on. So you get one external event, and that's what will cause massive rate cuts really quickly, is some external event that the Fed probably cannot control, other than to flood the market with liquidity. While if you short the June contract, then that happens, you get crushed. And in the world that we have now, that is not a zero probability of waking up one morning and saying, they did what? What happened? We're at war? You know, let's look at TLT. Tried to get across the 100 mark, but couldn't hold it. I had sold $100 calls, so I was thinking, okay, well, they'll be called away from me. I was okay with that, but they weren't going to be called away from me by the ex-dividend date, because what I had paid for the calls, or what I received for the calls, was significantly more than where the price was with the dividend. So there was no value in my particular ones being called. They weren't going to be called from me. So I still have my calls. I've made no changes to my position. We're sitting at 98.82. I think we're going to go sideways for a while. It would seem like the logical thing to do. I think like most other people, or most other people think like me, we've had a good run. Do we really think that we're going to have another leg up like we've just had? And if we did, I don't know that that would be healthy. I think we consolidate here. TLT up 0.41 over the week. SPY up 0.32. Both of them eked out again into the end of the year. And as I said last week, the week between Christmas and New Year's is a drift week. The market tends to drift in the direction in which it got there, and it certainly did that. Let's have a look at implied volatility percentile increasing on TLT 8%, up from 2% on the 13-week, 35 versus 30. And again, for this one here, I've made no changes. I don't anticipate making any changes on this one at this point. Okay, let's have a look at mortgage rates. Down again, 6 basis points, 6.61%. Interesting thing here. The 10-year is the same year over year, but mortgage rates are elevated. So the spread during 2023 had done nothing but widen. I think over 2024, as we settle down, I think that spread goes back to its historical spread, which is some 100 basis points lower than where it is. So the spread only decreased by 1 basis point over the last week, because the Treasury decreased by 5, the FRM decreased by 6. Mortgage REITs sort of gave up a little bit here. ABR gave up, and I think it's still the short sellers I call it short sellers, the short and distort group, they're not going to give up. They're still at it. What we have as investors in our favor here is it's quarter end, which means these are audited statements. So absolutely, the auditor is going to be looking at certain things. So when we get the earnings report, it will be an audited earnings report with an auditor that probably is going to say, look, we gotta look into this. Now, I mean, how can they just ignore it? I'm sure they're going to look into it. And then that should be the end of it. But ABR usually doesn't report until well into February, so there's maybe 6 or 7 weeks. I think the short and distort crew know they've got 6 or 7 weeks and are probably going to ratchet up their attack. I see this thing pull back. It is just going to be an invitation for me to buy something. Housing stocks kind of just mixed on this one. Same with the IYR, the REIT index. PLD, DLR, nothing much exciting there, and same with the home building ETFs, not much exciting there. Corporate spreads, OAS, continue to shrink. All of them continue to shrink. The IG is threatening less than 100 basis points. And where is our high yield? This is really incredible, 3.32. Look at CCC, 857. Wild. You want to know something else wild? Housing prices in October in the U.S. have never been higher, ever. Hit an all-time high, the house price index. So the house price index month over month, 0.3. Year over year, prices are up 6.3%. Keep in mind, 2022 was an ugly year for interest rates, and this year wasn't as ugly as 2022, not as many rate hikes, but we still went higher. And housing prices not only went up, but went up even higher than the peak before interest rates started to climb. Think about that. When we look at equity markets, you have equity markets, a couple around the world hitting all-time highs. The S&P just a smidgen below all-time highs. Housing prices in the U.S., all-time highs. If I said this, you'd say, wow, the Fed must have really flooded the market with liquidity. No, quite the opposite. They pulled back aggressively. Then you would say, then what does the Fed matter? I mean, if the Fed floods the market with liquidity and the markets hit all-time highs, and then they pull a whole bunch of liquidity up and the market hits all-time highs and housing hits all-time highs, does the Fed not have any cause and effect then? Because you've had the same outcome with two different actions, right? Science would tell you, well, I think you're missing something there. There must be something else in there because the variable you have has zero explanatory power. I mean, if you're saying it can explain markets going up, then the opposite must have the opposite effect. And if it doesn't, you don't have an explanatory variable. I find that very interesting. Case-Shiller, 0.1 year over year, 4.9 all-time high. When I say all-time high, I really pay attention to Case-Shiller. All-time high on the pricing index. Wow. Canada. We got our index pricing on December 19th, 304.76. It has been drifting down into the final quarter of the year for November, but there is a seasonal effect to it. May of 2022, the housing price index hit an all-time high of 323.51. So based on where we are here versus May of 22, we are down roughly about 6% on the housing price index, which I think is going to correct in 2024 as interest rates come down. Hit a low in August of 23 of 314. We had an intermediate high from a high to a high. Had an intermediate high of 314.71, and we are drifting down. And it did the same thing last year. It drifts down. Then once you get into January, February, March, April, May, it moves up. You have the spring buying season, which is there, and I anticipate that we'll probably have at least one rate cut by Bank of Canada somewhere heading into or midway through the spring buying season, which I think will bring a whole bunch of people out and to purchase, and I think the floating the floating rate mortgage will be the big thing. Why take a fixed rate now? If you're buying in Canada, buy at a floating rate. Over the next year, your monthly payments are only going to decrease. That floating rate is going to decrease your monthly payments, and then you can lock in a fixed rate maybe in 2 years when rates have dropped enough. But I don't know why you'd put out a fixed rate mortgage in Canada now. I'd be taking 1 year floating rate mortgages, or maybe lock in a 2 year floating rate mortgage, maybe. And then flip it into a fixed rate. I think that we still have a significant housing shortage in Canada. Significant housing shortage. It can't hold. You can't have prices go down, population increase at the same time, especially if interest rates start dropping and affordability starts increasing, and you continue on with 4% wage gains. This is a coiled spring waiting to bounce. I think that housing prices in a year, looking at the end of 2024, those who didn't buy would have said, if only we had done it a year ago. If only we had bought a year ago. Okay, let's get to the theme for this week of this video, which is my best ideas for 2024. And you'll notice in here, I don't have the market. Because it's not my best idea. The SPY is not one of my best ideas. What I want to do is this. If I can only make an investment decision on January 1st, and I cannot change it till December 31st, what would I do? I cannot change it now, which means I have to say, not what kind of economy do we think we're going to get, but I have to say, what are the possibilities for the economy? There is continued resilience, and there is always some probability of recession. That exists at all times. You can elevate that probability to say conditions are much stronger now for a recession, or you could lower those probabilities, but they always exist as a base probability. So I just left it as a base probability. Then I started thinking, well, if interest rates, if the market does well, what do I want to do? If the market does poorly, what do I want to do? And if those things that I do are the same in both, that's my best idea. So the biggest one is interest rates. If the economy does well, I think inflation still continues to come down. If the economy does poorly, rates are coming down. Either way, I believe rates are coming down. Under both scenarios, I don't need to know how the market is going to do. I think rates are coming down. So my big theme is you're going to see lower rates through 2024. Now we can question whether or not that's already been priced in. That's sort of the second step of what you want to do when you start looking at different asset classes. Say, well, to what extent is that theme already priced in? But divorced from the market, it is a theme of 2024. That will be, I think, the trend in interest rates is central banks will start easing. Not just in the U.S. I think globally central banks will start easing. So as each one eases, it incrementally adds to the global liquidity that's out there. And lower inflation is the theme of 2024. And I think that by the end of 2024, we will be talking about it being long-term secular. I'm still hearing, I think that inflation will be sticky for the next 4 or 5 years. I'm still hearing that conversation that, we had a global shutdown and a reopening so that supply channels would be messed up is a logical conclusion to reach from something like that. That it would cause shortages in certain areas is a logical conclusion as well. Previous to that, we had no inflation. You had interest rates globally pretty much at the zero line. You had growing global GDP every year. You had a good China story, and you had no inflation. So why do we think that just because you had a pandemic, things would be different? We ended up with the global supply channels we had because it was efficient, and technology made it efficient. that if you couldn't move something, you brought technology into play to make it more efficient. The big three. Here's a good example of something that was very well, I wouldn't say deflationary, but certainly avoided a lot of inflation. The Detroit Three. And the move in the 80s to copy the Japanese style of just-in-time inventory. So you can't move your supply channels very far when you're dealing with heavy stuff. So you change the way you do business, not the location, but the way you do business with technology where it is today. That we didn't have that in the 80s, but where it is today, along with some I think advances that we're going to see in the predictive AI space, not the generative, but the predictive AI space, a supply constraint can be overcome with localization and technology. So I don't see, I'm not on board the longer term secular inflationary story that we're going to be moving into an inflationary world. I'm just not on board that because of technology. I think long term, the backdrop, the global backdrop is deflationary. So duration wins. No matter how I look at it, duration wins. So if you buy now, if I bought on January 2nd, I bought bonds, I would get the current yield plus I'll get the change in yield. That's where my duration comes in. And mortgage REITs, I think, will do very well because I think the not only will yields go lower, but the spread that should help accelerate the mean reversion of the spread to under 200 basis points from slightly. I think we're about 280 basis points now. So MREITs, and if I don't really want to buy MREITs, I think this is a great place to sell puts on MREITs. Maybe you don't feel there's a lot of upside, but I don't think there's a lot of downside. So that's why I don't mind holding it at these yields. You're getting upwards of over 10% yields on these things, plus whatever increase in price that you get. So even if you have agency go from $10 to $11 all year long, that's a 10% return on the price, along with a 12% return on the dividend, 22%. That's not a bad year. So I would say, well, I'm going to buy some bonds. I'm going to get some duration out of that. I'm going to make it as tax efficient as possible. So I'm going to look for low coupon. If you're not too concerned with the liquidity, you'll go for zero coupon. But if you're going for zero coupon, there are coupon strips and there are principal strips. Take the principal strips. And MREITs. I would also add utilities. Because if rates are going down, utilities will benefit from that. And also, if we have a recession, they are extremely defensive as well. They will outperform the S&P in a recession. The S&P will outperform utilities in an expansion, but utilities have been beaten up. So I think the S&P has rebounded nicely, but utilities are haven't had their rebound yet. With utilities facing asset growth of 6 to 8%, regulated asset growth of 6 to 8% for the next 5 to 7 years, I would definitely be taking utilities. And even if I had to go to sleep for 5 years, I'd probably still stay in utilities. My recession concern, as I said before, is can rates drop faster than the lags take effect? Now, I do think that the U.S. economy is less interest rate sensitive, but they're not interest rate insensitive. I think at higher rates, you're going to start affecting the level of credit that is available significantly. And if you do that, if there's a big contraction in the amount of credit available, that's a big problem for the economy. Emerging markets, Mexico and India. Mexico and India. By the way, Mexico had the second best performing currency of, well, not 2024, let's change out of 2023. The second best performing currency of 2023. Better year than the US dollar, but everyone kept, when the dollar was strong, everyone kept saying King Dollar, and the King Peso. Even when you had King Dollar, the peso was still beating it. And the Indian rupee was the third best performing currency in the world in 2023. So you have both the second and the third best performing currency. India, I really do believe, is the next China. I think the India story is not a short-term story. I think it is just as long a term story as it was, as China was. And India is more friendly than China is. India has a democratic structure versus what China has. They're more open. So I think that they could probably do even better. And they have a population that's larger. So you need a large labor force if you're going to move a lot of your manufacturing over to India. If you're going to make it the next China, you need big labor force, and India has that. So I would look to India as being the next China. I would look to Mexico as being the local China for North America. They have a fairly large population, not really big, but large enough that you can put a lot of manufacturing into Mexico to avoid what we're seeing with union strength. So companies that can, I think, will look to expand into Mexico. And that is along the lines of adding resiliency to the supply chain, and labor costs in Mexico are cheaper than labor costs in China. So it just seems to me that they would continue to win. Well, if this is the case, they all need foreign direct investment, FDI. And if they need foreign direct investment, the currency is where you want to be. So I would say long equities unhedged. So even if their markets go sideways, if their currency strengthens, your local return will increase. So if their markets do go up and their currency strengthens at the same time, that's what it looks like. So you can have, India's markets are on fire. You can have a sideways market for 6 months, but if the rupee is continuing to gain strength, or the US dollar is losing strength, whichever way you want to say it, you'll still get positive performance because you're combining a currency play with an equity play. So if I had to, I would say, well, I would want to be in equities unhedged. I wouldn't make a currency play and say, let me just be long the currency. I'd want to be long the equities because I'm going to get some kind of dividend, some kind of income component out of that, some kind of capital gain, and I will get the currency. So I think for emerging markets, those two definitely, and India's a 10-year story. Easy. Mexico, same thing, I think is a long-term story. The peso, I think, started the year over 20, ended just around 17. Which is a good performance. We're at 17. It wouldn't surprise me at the end of 2024, barring a massive global recession, some external event where money has to run and hide. If we have the economy we have now throughout the year, where we just keep chugging along, the peso under 15. I don't know about getting back to 12 and 13. Where it was years ago, like some good 10, 12 years ago. I don't know about getting there, but under 15, I could see that. Copper, gotta be in copper. EVs, you have Canada now that has made a decision for consumers that you are no longer going to have a choice. You're going to have to buy an EV, whether you like it or not, by 2035, unless you buy a used vehicle, but no more new internal combustion engines. I don't know that is going to stick around. You have the green transition continuing on, and if you have Mexico and India attracting foreign direct investment, you got to build stuff. Building stuff takes energy. Anytime you have energy and you're moving electrons, you need copper. Infrastructure and the capex necessary to create a mini China and a major China. You got to be long copper. U.S. housing, home builders, you still need more homes. Even if interest rates are lower, you still need more homes. Home builders will just build bigger homes. Or you could just stick with the ETFs, the XHB or the ITB, but I would probably still stay long U.S. housing. And Canadian apartment REITs, I think, continue to win. If you look at the presentations by these, especially by CapREIT, CAR, they provide a lot of really good data that shows where population growth is and where home construction is, and the gap that'll just get wider and wider. You got to live somewhere. I mean, you have to live somewhere, and I think apartment REITs will be the natural beneficiary of that. because our housing shortage in Canada, because of our population growth, is worse than the housing shortage in the US. Much worse. You could probably start to fix some of the housing shortage in the US if interest rates come down significantly, because some of that locked up supply would hit the market. In Canada, even if it did, you still have a housing shortage because of the population growth. So I think Canadian apartment REITs continue to win. My top two favorite ones are CapREIT and Killam. Killam is on the East Coast. CapREIT has a presentation or representation in almost every province. Those would be my two favorite ones, or my top two. There's really only 5 Canadian apartment REITs. I'm not counting Northview's new. They had a high yield fund which they've now turned into a REIT. I'm not counting that one, nor am I counting Boardwalk, because I just don't like Boardwalk. Maybe it's a good investment, but I don't like them. So there's really only 4, Interrent and Minto being the other 2, which are primarily Ontario based. In Canada, reporting is done under IFRS. So these properties are listed at fair value. And as interest rates went up, you had fair value losses. As interest rates go down, you're going to have fair value gains, which means book value per share should increase as interest rates drop. So not only will you have, I think, good rental gains year over year, high levels of occupancy, very strong funds from operations, you will have fair value gains on the balance sheet that raises the book value of these companies. It would not surprise me, and I'm not projecting this, it would not surprise me if one of these were taken out by a private equity a fund in the space, much like Northview Apartment REIT was taken out by private equity, private real estate fund. It wouldn't surprise me if one of these were, because I think the Canadian apartment REIT story is not just a one-year story. It is a multi-year story, because you have to build houses in Canada. And there's just so much regulation, and it takes so long to get done, and I don't see government really being a solution to any of this kind of stuff. Yeah, I think this is 4, 5, 6 year play. I think if you bought the apartment REITs and you simply just went away, and both of them have DRIPs, DRIPS, dividend reinvestment plans, where your dividend is paid to you in more shares. You could just sign up for each of their DRIPs and then just go away. Stick these in your RSP or your TFSA and just go away. Come back in 6 years, and I think you'll be, well, if they stay private for 6 years, that is. U.S. oil and gas exploration and production, especially those in the Permian, which is Oxy, and Oxy just had just bought another company with assets in the Permian Basin as well. And they tell us when they bought it, this is going to be accretive to earnings right away. So we'll find out in February when they report. Oxy, I would continue to sell puts. I would continue to sell puts just based on their free cash flow yield, based on Warren Buffett still buying more. He bought more. So he has a tendency to take companies off the market, that have very good, strong cash flows. I'd be selling puts at 55 and 57.50. Anytime it really starts pushing down under the 58 mark, down towards 57, I'd be selling these. In the times that I was selling these, they never got put to me. It was one of my top performers, and without owning it, one of my top performers, just aggressively selling the puts because I thought this is free money, and even if it's put to me, I'll take it. But it's just free money, so I continued to do that into 2024. GM, with their share buyback, buying back $10 billion worth of share, I would sell puts, but at a 30 delta. I had recommended earlier to sell the $38, $39 puts when GM was sitting around $32 a share. And I did a quick calculation suggesting that if they buy back the shares and they maintain the same market cap, that their shares would have to rise to about $38, $39. But since then, the price of GM has been going up, so GM's had to buy back shares at higher and higher prices, which means they're not going to buy back 25% of their shares, just 25% of their market cap. But their market cap was going up as they were buying shares. So my best guess is somewhere below $38 would be the price of GM without any more buybacks and without any increase, without the market giving it any increase in their market cap. And they're sitting at 36 and change right now. So it was done in a month. I think that that whole story is done in a month. I don't know that I can continue to sell 38s, 39s, but I'd look at 30 deltas on GM and I'd say, I'll sell that. They've really pulled back on cruise. They're going to not invest what they would have said is hundreds of millions of dollars in there. And they're being a lot more cautious about their EV strategy. Even though they say they're not abandoning the EV strategy, they're just not going to go at it as full force as they had in the past. They may, if their share price gets no respect in the market, which I expect it won't get any respect, I think that they will probably do this again in sometime in 2024. I think they'll announce another share buyback because if the market is giving them no respect, listen, their free cash flow, just their free cash flow alone in 4 years, they could be a privately held company with one person holding one share worth $40 billion. They could just keep buying back shares if the market is giving no respect. At some point, you're going to push the price of the stock up. And if they really do believe they've got this fantastic future, given the price they're trading at, given the market cap that they have, there is no better investment. Don't invest in another EV plant this early. Buy back your own stock. You probably have the largest return. So I would be selling 30 delta puts on GM. Now comes the hard part. What about the broader market? I don't know. That's the thing. I don't know. And when I don't know, that means that I think that you're probably best to avoid a macro play like beta at the level of the market and just look for more micro picks. There are some reasons why the market can push higher, but there are some reasons why the market won't push higher, and both fundamental and technical. You know, on the technical side, you can make the argument that we are about to break the last previous high and print new highs. That's a breakout and off we go. The other side of that is no, what we're forming right now is a double top. A top you had almost 2 years ago. It would be wild if the market on January 2nd, the first day of trading, rose to pretty much the same level it did before, the same price, and then went down from there. A perfect double top. A perfect double top. It would also be wild if the market printed a new all-time high on the 2-year anniversary of its last all-time high after 2 years of interest rates going straight up. What a story that would be. I mean, that would, I think, have finance professionals and economists scratching their head for some time saying, okay, how do we explain this, right? But when you don't know, then there's equal chance that it could go up and down. And in my mind, I think, yeah, I'm probably 50-50 on this one. That you could probably get through 2024 and find that the market delivered a T-bill rate that, yeah, it went up, but maybe you probably could have done just as well by locking in the 1-year rate right now. I just don't know. So because I don't know, I don't want to make a beta bet. I'll make a duration bet, and I'll get my beta in Mexico and India, and I'll go into copper, U.S. housing, Canadian apartment REITs, things that I think that even if there's a recession, they'll hold up pretty good, and if they do drop, the underlying problem for their investment thesis has not gone away, right? So if I buy something like Microsoft on the AI revolution and generative AI turns out to be a bust, that's a theme that simply just goes away. But if I buy the Canadian apartment REITs and there's a recession, they drop in price, the underlying investment thesis has not gone away. It's still there waiting for me when the dust settles. So I want to try to stay away from things that seem like they have something, but if it's nothing there, the whole investment thesis goes away. There we are. Okay, let's look at the SPY, both IBES and SP Global didn't update their spreadsheets. It's the week between Christmas and New Year's. Let's cut them a break. That's fine. No updates here. We'll stick with the previous numbers that we had. SPX did go up, so the multiple did inch up slightly, 20.36, but basically unchanged. The same story as last week. I said expect a grind higher into the end of the year. What did we get? We got a grind higher for 477.05. It tried to flirt with all-time highs. It looked like it was going to do it before the end of the year, and the market pulled back saying, no. Let's do it on the exact anniversary date of the last all-time high. 477.60. We're at 475.07. If we have a 27-point rally in the S&P on Tuesday, there we are. We need 28 points. So you got a 30-point day on Tuesday, you got all-time highs. But the market did print a new high this week, a new closing high of 477.05. 477.60. Look at that. Spitting distance. Spitting distance with damage. Not one that just catches you on the side of the shoulder, but one that hits you right in the face. Down 0.53% from an all-time high. 2 weeks ago, we were down 1.54. Last week, we were down 0.925. Now we're down 0.53. That's the grind higher. I said you get this little grind higher, and that's what we're getting. Earnings will start next week. So the week coming up, labor reports. We got 3 big labor days. And then next week with the banks, late in the week, I think Thursday, Friday, we start with the earnings. IVP really dropping off 37% down to 11% on the 13-week. And this week we have a few earnings, all from consumer staples. Conagra, Lamb Weston. This is on Thursday before the market, Friday before the market. A little bit of alcohol for you. Lamb Weston, if you like your French fries, you go to the frozen food section of your favorite grocery store, and a lot of their products are in there, and they performed well. All the way through the rate hikes, they continue to perform well, but that is what they are into. It is a consumer staples. That's it. There's not much to talk about. No bond sales, no Fed speak, little economic data. The one we have, ISM manufacturing, is, well, okay, that's fine. It's just a big week for jobs. And then next week, earnings start, and I guess the big thing that we're on watch for is a new all-time high, 475.07. We got to get to 477.60. Let's see if we can get it done.